Does the bucket strategy hold any water when it comes to keeping your retirement safe? Or is it all hype with little to no benefit? That's what we're going to explore in the main topic today, and we're also going to learn how I was first exposed to the bucket strategy. Because in today's story, we're going to be covering my experience with Dave Ramsey's Financial Coach Master Training. What I was told in this training is going to shock you. Good morning and welcome to the HopeFilled Financial Podcast. My name is Jay Disberger, your one and only HopeFilled Financial Coach, and I'm happy that you're here with us today. Last week, at the end of episode 73, I teased that I have a potential disagreement with the money guys, and this disagreement revolves around the emergency fund. Most experts are going to tell you to have 3 to 6 months of your expenses saved up in your fully funded emergency fund. And I'm no exception. That's what we covered for HopeFilled Financial Footstep number 4. But once you hit retirement, does the emergency fund need to change? Well, the money guys said you expand your emergency fund to 1 year, 18 months, maybe even 24 months, 2 whole years worth of expenses. And there's a reason for that. That's what we're going to cover in the main topic. But the money guys were not the first place that I heard about the bucket strategy. The first time I heard about the bucket strategy was 4 years ago when I was taking Dave Ramsey's Financial Coach Master Training. Now, some of the HopeFilled Financial followers have been asking me what was it like to go through Dave Ramsey's relatively expensive Master Training to become a financial coach. It's pretty clear on my website that I went through the class. So, back in 2020, right before the plague shut everything down, I was on YouTube, sort of looking around, and it was right after I started getting some questions at work about personal finance. And I started thinking that this would be something I would like to do, that a financial tutoring or coaching outlet for me would be a good way to serve people. It would be very rewarding and it would tap into my natural talents. Well, as I was thinking this, YouTube fed me an ad for Dave Ramsey's Financial Coach Master Training. At the time, I was all in on the Dave Ramsey plan. I had drank the Kool-Aid. I had taken the foundations curriculum as a homeschooled kid. We've talked about that. And I remember telling my wife that I wanted to try this whole financial coach thing, and maybe taking the training, Dave Ramsey's program, would be a good way for me to learn how to step into this area, step into a field, at least as a passion project, where I could help people. She thought that was a great idea. And without her encouragement, I probably wouldn't have jumped into starting HopeFilled Financial Coaching as fast as I did. Without taking the Financial Coach Master Training, I probably wouldn't have. It was sort of an investment in a push to commit myself to running HopeFilled and being your one and only HopeFilled Financial Coach. With that said, when I took Financial Coach Master Training, it was primarily a series of videos that were recorded by Chris Hogan doing the class in person at the Ramsey Solutions campus. This is before he was let go from Ramsey Solutions. This was before the whole controversy, so he was still a mainline Ramsey Solutions personality. So in going through Financial Coach Master Training, you would watch videos of Chris teaching the class in person, going through slides, and telling you what it's like to be a financial coach. The first portion of it, from what I documented in my notes, involved what it's like to listen to someone else's problems with personal finance, listen to someone else's goals with personal finance, and how to break them down into different categories before providing recommendations that can help lead the client to change. There's a big emphasis on you not being the hero in your client's story if you're a financial coach. The whole role of the financial coach is the interesting person that they meet on the side of the road at the beginning of a journey who says it's dangerous to go alone. I need you to take this wisdom with you as you go and you conquer your story. The client is the hero, and you are simply a sage advisor or a coach or a friend. You are not Frodo. You are Sam, encouraging Frodo along the way to complete his hero's journey.
Sam, I'm glad you're with me.
Anyway, this was really helpful to kind of get a healthy mentality for coaching, and also to be given a general structure for pricing and how they recommend that you go about running a coaching business for starters. I do recall that they discouraged you from getting a website all sorted out. At the time, I'm pretty sure they were working on setting up a website tool so that if you subscribed to the monthly payment system, the Ramsey Preferred Coaching Program, after the fact, that you could get the website through that and sort of have a reason to keep paying in monthly for that website. Even though at the time that website tool was not fleshed out very well, I did get to see a little bit of it because I joined the Ramsey Preferred Coaching Program for a brief period of time, but it wasn't anything compared to what I could do through a website builder. There was a little bit about branding and marketing, and that did help inspire me as I was working on what HopeFilled Financial Coaching is today. But I don't know if it was necessarily fully essential. Other than that, the bulk of the class was like Financial Peace University on steroids. You really dove deeper into the topics, and you talked more about the actionable items and some of the finer details that just can't be covered in a 9-week class that's designed for a general audience. With the exception of retirement, looking back at my notes, I have 2 pages that covered retirement. It's interesting. There's a quote from the session I took on April 4th of 2020. It was from section 11.3. It says, good retirement planning involves 2 things, time and money, duh. And a quote, a dream without a plan is a wish. I think that's a brilliant quote. I think that's another way of saying begin your plan with the end in mind. Because if you don't have something to aim at for the end of your plan, you don't have a goal, then all you have is a wish for something more than this. Now, in addition to the videos where I watched Chris Hogan and I took notes, there were little quizzes at the end of each section, and after an entire unit, you would have a Zoom meeting, basically with other individuals who were taking the training with you online. And there was a facilitator who would answer questions and facilitate group conversation. But there were some particular details that I felt were lacking. Like, how do I convert the nest egg into income? The whole basis for my disagreement with Dave Ramsey on the 8% stuff. And it was really around this time that the seed was planted for me to pursue a good answer here. In the breakout session that followed the unit on retirement, I remember specifically asking the individual from Ramsey Solutions who was coordinating the call, I want to know how to safely turn retirement nest egg monies into income without running out, because I've been reading up on it. And I don't know if there is a definitive direction from Ramsey Solutions that we can take as inspiration for our coaching practice. And they simply said, well, the best approach that we know here, and I don't know if he was speaking just from himself, if he was speaking from other people in the Financial Coach Master Training team, or what, because it's clearly not something that I've heard from Dave. He said what you do is you take your emergency fund and you boost it once you hit retirement to a year or 18 months or 24 months worth of expenses, so that if the market has a downturn, you can live off of the cash while the market recovers, i.e. the 2-bucket strategy. I have it in my notes right here that this emergency fund becomes structured in the case of a recession. That was the whole purpose of this answer. Now, I found this answer at the time satisfying. I was like, that's the answer. If I have a client who rolls around with this sort of question, I have an answer. But after mulling it over, I realized that just taking someone's word at face value without being able to substantiate it was not something that I could do as a coach. I don't want to share anything with you unless I feel like I definitively understand it, unless I feel like it's something that is worth your time to dig into. So I started reading up on the 2-bucket strategy, on an emergency fund that is used in the case of a recession after you retire. And I kept finding conflicting information. I found that it's a very popular strategy, but I didn't find consensus on whether or not it worked well. And I decided that the best way for me to understand it would be to build a model, a retirement model, to successfully grasp how distribution strategies can affect your odds of running out of money. That way you could get a good educational grasp around how good a particular strategy is at cushioning you from sequence of returns risk. So I taught myself how to build Monte Carlo simulations in Excel and went whole hog on this ridiculous spreadsheet model that utilized the bucket strategy. I was pretty sure this was the answer. And I remember that all the solutions, all the statistics I was getting out of this spreadsheet were utter garbage. It's not that the way that I built the model was poor. It's not that my assumptions were poor. It's that the model for the bucket strategy was not yielding any fruitful results that I felt like I could use relative to a flat, safe withdrawal rate. I didn't quite finish the full study back then when it came to the bucket strategy. I simply threw it out the window in lieu of what I've already shared with you on the podcast before, a financial guardrail approach. I found that a flat, safe withdrawal rate can work if it's low enough, and that 8% was too aggressive because it was around this time that I had discovered Dave Ramsey saying 8%, trying to learn more about this topic. And I had decided that the bucket strategy didn't have enough of a benefit to really pursue any further. But since I started the podcast, I've been getting questions about it. Is the bucket strategy actually viable? And since I've gotten better at building these spreadsheet models, I figured it might actually be interesting to try to finish what I started 4 years ago so I could share it with you and we can explore together if the bucket strategy has anything to stand on. And that's what we're going to do now in the main topic. Now it's time to get into the meat and potatoes of my potential disagreement with the money guys. Should you have more than a year's worth, up to 2 years worth, of your expenses saved in an emergency fund, effectively in cash, when you're retired? Should you use the 2-bucket strategy when it comes to retirement? If you're not familiar with the bucket strategy, then a lot of the story might not make sense right now, but it's effectively this. Imagine you have your investments, be them in stocks, equities, or bonds, or some sort of combination of the two. You keep them balanced. You exercise traditional rebalancing between them. And that is your nest egg. It's grown to the point that you feel like you can retire, but it's volatile. You are not comfortable with how much the market goes up and down, how much your nest egg's value can fluctuate even month to month. And why are you uncomfortable with this? Why are you uncomfortable with the volatility? Well, when the market's up, that's not a problem. But if it's down and you want to take some income out of this nest egg because you need an income coming out of your nest egg every month, if it's down, it's not a good time to take money out of the market. It is an inefficient time. In short, volatility is scary, and it would be nice to not have to rely on your nest egg when the market is down. And that's the whole philosophy behind the 2-bucket strategy. You keep that 1 to 2 years of expenses in cash so that you can live off of it for the duration of a recession when the market is down. That's kind of the idea. Simple. On the front of it, you've got your nest egg over here, invested, and you got your cash over here. And depending on how your nest egg is doing, you live off of one or the other. That's it. Well, I wish I could say that's it, because there's a problem. If you have your cash bucket depleted, in part or in whole, how do you go about filling it back up? And how do you know when is a good time to fill it up? Do you just start filling it up as soon as it's empty? Do you fill it up once the market's recovered? And what's the definition of the market having recovered? Does it need to exceed when you started pulling out cash? Does it have to hit a new high? Where are the boundaries here? What are the assumptions? And then when you are ready to start filling it back up, do you do it all at once? Do you do it progressively over time? If you fill up your cash bucket too fast, you may unduly deplete your invested nest egg. And if you fill it up too slowly, you might not have enough cash by the time the next dip hits, and you need to go back to withdrawing from your cash bucket. Now, if that wasn't clear enough and you have access to the video version of the podcast, I created a flowchart example for us to walk through to help us make sense of the situation and make sense of how I modeled my 2-bucket strategy simulation. What we're going to do now is walk through this visual aid to help understand the assumptions that I made in modeling the 2-bucket strategy. What we have up top first in the orange bucket is your investments. That's going to be bucket number 1. The blue represents your cash bucket. This is going to be your 2 years worth of emergency fund. I did try modeling 1 year, 18 months, and 2 years. And what I found is that the 2 years was nearly optimal for the 30% bonds, 70% stock portfolio. And then below that, we have the green, which represents the income that is coming out of either the orange bucket or the blue bucket, bucket 1 or bucket 2. And we're pulling that every month. Next, we're going to talk about this line graph. It's the example to illustrate the floor and fill lines. When I covered the financial guardrail method, I talked about a floor, where you take the amount of money that's invested in your nest egg and you correct it for inflation. That way you have a line that represents the initial buying power. And anytime your nest egg dropped below that line, anytime your nest egg that was invested fell below its initial buying power, you would default to a more conservative safe withdrawal rate until the market recovered. Well, in this case, we're going to maintain that trigger. Any monies that are invested get corrected for inflation, and anytime the invested amount in bucket 1 falls below its initial buying power, you're going to default to using the cash bucket. You're going to start withdrawing from bucket number 2 until the market recovers. But if the market were to recover just barely above the red line, and you started taking money out of bucket number 1 to fill up bucket number 2, you're going to put an increased pressure on your invested nest egg, an increased pressure on bucket number 1. This will result, probably in many cases, dropping below the floor again. So you end up with this oscillation, this little confliction of how much can I pull without pushing myself down to the floor and needing to keep pulling out cash. And it is for this reason that I don't use the red floor line as the trigger for filling up bucket number 2 again from the surplus in bucket number 1. That's what this yellow line is. The yellow line is, in this model, representative of the floor line shifted up by 1 year's worth of expenses. So if you had a 4% safe withdrawal rate that you were applying with the strategy, this would be 1.04 times the floor across the board. So once you get 1 year's worth of expenses above the floor line, inside bucket number 1, you can then start filling up bucket number 2 from the surplus. And in this model, I have assumed that you fill up the cash bucket, bucket number 2, at a rate of 2 times your monthly income, 2 times your monthly safe withdrawal rate. So in a month when you are filling the cash bucket, you're pulling out 1x of your monthly expenses for you to live on, and you're pulling an additional 2x of that same number to put into bucket number 2. Effectively, if your cash bucket is depleted by any amount, once you get above the fill line, you take out 3 times the pressure from bucket number 1 until bucket number 2 is filled. And because that's kind of confusing, I've developed a flowchart to walk us through the decision-making process that becomes relatively complicated for a concept that looked so simple on the surface. Okay, the flowchart starts here at the gray circle, the month starts, and the first question that's asked is, does bucket number 1 exist above the fill line? If so, the next decision is easy. Just take your monthly income out of bucket number 1. Don't worry about bucket number 2. After that, you need to ask yourself if bucket number 2 is full. If it is, then you can move on to the end of the month. That's all the decisions you have to make for now. But if your cash bucket is depleted, if the answer to this decision is no, then we come over this way and engage with the assumption that we need to fill the cash bucket up by withdrawing from bucket number 1 up to 2x our monthly income to put into bucket number 2. Now, this is as good a time as any to say that for the cash bucket, I assumed that it was invested in a high-yield savings account and maintained through surplus in the budget so that it never fell below its initial buying power once it was full. So naturally, you're going to engage with this step up to the point that your second bucket, your cash bucket, hits its initial buying power from when you started retirement. If you go down this path, you're done. You can go over and end the month. Now let's go back and say your nest egg isn't above the fill line. You simply say no. Well, now we have to ask ourselves, is our nest egg below the floor? Because if it's below the floor, the next action is clearly going to be going to bucket number 2 and trying to get our income from it. However, there are cases where you may be more than 2 years in a recession. You may have completely depleted everything that was in the cash bucket. So it's important on the flowchart to ask if bucket number 2 had enough money for your income. If so, that's it. You go and end the month. But if not, you have to engage with the behavior that the bucket strategy is trying to have you avoid, and that is taking money out of bucket number 1 when the market is down. Do this up to the amount of money that you need for that month and then end. But what if you were here and you said, no, my nest egg isn't below the floor? So you said, no, it's not above the fill line. No, it's not below the floor. Well, now you live between the yellow and the red lines. You live in limbo. And this is where the model kind of gets extra confusing, because do I take out cash now or do I take out from the investments? Well, this is going to be dependent upon how last month's income was withdrawn. Because if we came from above the fill line, dropped below it, but hadn't yet hit the floor, we should still be taking out a bucket number 1. Meanwhile, if we were taking out a bucket number 2 because we fell below the floor and we were coming back up, but we hadn't yet hit the fill line, we should continue taking out of the cash bucket. That's why this decision-making factor right here was last month taken out in cash. If the answer is yes, you continue taking out cash because you're still waiting for the market to recover. If the answer is no, you continue taking out of bucket number 1 because you have not yet fallen below the floor to trigger needing to engage bucket number 2. I hope that flowchart and the visual was helpful for understanding how I made this model. It was a little difficult putting it into a spreadsheet, so this particular one took much longer to run than my initial study. And before we get into the statistical results, I want to tell you I did use my inflation-corrected data. I didn't assume a flat 3% for inflation. I had an episode just recently where I redid my study and said, let's make everything relative to actual inflation, and that was extended to this work. So, how well did the bucket strategy actually help us in different scenarios with different portfolios in bucket number 1 and different time horizons? To answer that question, let's look at the 20-year time horizon data, which looks more similar between the flat withdrawal rate data that's on top and the bucket strategy data that's on the bottom. Really, across the board, for the 20-year period, there is almost no tangible difference anywhere with any practical portfolio that I can point at. There are minor changes within like 0.2, 0.4%, but none of them changed the boundary for the 95% confidence line or the 90% confidence line within the confines of my study. When it comes to the average expected ending nest egg value, the amount of money that you could leave as an inheritance, across the board for the practical results, I see that the bucket strategy reduces how much you leave to your heirs by 100,000 to maybe 400,000 across the board for the practical portfolios in the 20-year time horizon. And it continues to blow my mind just how close the data is here for the 30-year time horizon. For the lower safe withdrawal rates, it doesn't matter if you use the flat safe withdrawal rate or the bucket strategy, like at all, regardless of the portfolio mix. The results are effectively the same. When you get up to the higher safe withdrawal rate, say 4 to 5%, the bucket strategy may give you a benefit, a slight benefit, depending on the portfolio mix you're using. For example, the 30 bond, 70% stock mix has an additional cell. The 4% safe withdrawal rate is now added to the 95% confidence line. But before, it was 94.8% confidence. It was pretty stinking close already to being within that boundary. The change is so small. And again, with the average ending nest egg value across the board for the practical portfolios that don't end up leaving you with a diminished buying power, I see that the bucket strategy reduces what you can leave to your heirs in the 30-year time horizons from $200,000 to closer to 1.5, maybe even $2 million. That's incredible. It continues to blow my mind that a strategy that is designed to be more efficient ultimately ends up costing you money in the end, because in an effort to be efficient for monies that are invested, it is sidelining too much money to actually get you ahead if your main goal is to maximize how much you leave to your heirs. For kicks and giggles now, I'm looking at the 60-year survival rate data. This is the longest time horizon that I ran. And again, the odds of survival between just taking out a flat safe withdrawal rate and implementing the bucket strategy with any base safe withdrawal rate is negligible. In fact, the boundaries again for the 95% confidence in the 90% confidence are the exact same between the results. Okay, so effectively what we have here, if your goal is to minimize risk, and you want to minimize risk by implementing the bucket strategy, you're simply engaging with a placebo effect. It is a more complicated strategy from a decision-making process that gets you from the model I had, absolutely, positively, no gain over a flat safe withdrawal rate approach for mitigating sequence of returns risk. And because there really is no difference, I can't say that it's a bad strategy for mitigating risk. It just has an equal in something that is simpler. I believe that this strategy falls short of making goals a reality compared to a flat safe withdrawal rate. Within the confines of my study, within my assumptions, there is no benefit to it unless it helps you sleep better at night. And there is something to be said about that, but it's also a more complicated system to run. If you can become more comfortable with a strategy that's more viable, that does a better job, then hopefully you can sleep at night better implementing that, knowing that it is safer than keeping 2 years in cash on hand throughout retirement. Now, for the sake of completeness, I want to explain one more assumption that I made. When it came to the way that I modeled the nest egg, I said that the initial $1 million that you retire with includes the cash. So imagine you invested until you hit $1 million, and when you're ready to implement the bucket strategy, you take the cash out right away on day 0 or day 1 of your retirement. Make that your bucket number 2 and leave the rest as bucket number 1. And your safe withdrawal rate is still based on the initial nest egg value that you had between the 2 buckets. I didn't want to assume a diminished income in order to apply the bucket strategy. To do so may skew the results by basically shifting all of the withdrawal rates to something that's lower if I made it relative to what I left only in the nest egg. And in other words, if I were to say $1 million is invested and the cash bucket is on top of that, well, I'm basically just throwing money onto the pile and skewing the results in the favor of the bucket strategy by feeding it more money in the simulation. You see, I made these assumptions because I wanted to successfully illustrate the trade-offs of if you retired with $1 million and you could apply it to, say, a 4% rule strategy or a bucket strategy. You're not going to go and find newfound cash. There are trade-offs between that exact same amount that you have for retirement. And that's really what I've tried to illustrate here. And now I want to know what you think. Was today's episode helpful? Do you think that there are other assumptions or other tweaks to the parameters to the 2-bucket strategy that could make it more helpful and viable in some situations? Really, do you side with the money guys and their logic on this? Or do you side with the results from my study and experts like Rob Berger, who also stands against the bucket strategy as being a, mathematically speaking, good withdrawal rate strategy? I look forward to reading your comments. And until next week, until next Tuesday, budget bravely and enjoy your hope-filled financial future.